If I told you that one simple strategy could turn $500 a month into over $1 million without picking stocks, without trading, and without watching the market every day, would you believe it? Most people think building wealth requires genius-level investing or insider knowledge. But the truth is much simpler. Wealth in America has often been built quietly through something called the S&P 500. And today, I'm going to show you exactly how it actually builds wealth over 30 years and why time is the real secret. What the S&P 500 really is. The S&P 500 is not a company, it's an index. It tracks 500 of the largest publicly traded companies in the United States. When you invest in an S&P 500 index fund, you are essentially buying small pieces of companies like Apple, Microsoft, Amazon, Google, Nvidia, and hundreds more. These companies represent major sectors of the U.S. economy: technology, healthcare, finance, consumer goods, energy, industrials. But here's something important most people don't realize. The S&P 500 constantly updates itself. Weak companies get removed. Stronger companies replace them. Years ago, the index included companies like Kodak and Sears. Today, it includes AI-driven tech giants. The index evolves with the economy, and that's one reason it works. The magic isn't stocks, it's compounding. Let's talk about the real engine behind the S&P 500, compounding. Historically, the S&P 500 has returned around 10% per year on average over long periods. Not every year. Some years it crashes, some years it explodes, but over decades it averages out. Now here's where it gets powerful. If you invest $10,000 at 10% per year, after 10 years you don't have $20,000, you have about $26,000. After 20 years, you don't have $40,000, you have about $67,000. After 30 years, you have roughly $174,000. That's without adding another dollar. Why? Because each year you're earning returns on your previous returns. Money starts earning money, and then that money earns money. That's compounding. What happens if you invest monthly? Now let's make this real. If someone invests $500 per month into an S&P 500 index fund for 30 years at an average 10% return, they invest $180,000 total. But the final value? Around $1.1 million. Not because they invested $1 million, but because time did the heavy lifting. The first 10 years feel slow. The second 10 years feel noticeable. The last 10 years feel explosive. That's how compounding works. It starts invisible, then becomes unstoppable. Dividends, the hidden boost. There's another piece most people ignore: dividends. Many companies in the S&P 500 pay shareholders a portion of profits. When those dividends are reinvested, they buy more shares. Those new shares generate more dividends. Historically, dividends have contributed roughly 1/3 of total long-term returns. If you don't reinvest dividends, your long-term growth shrinks dramatically. This is why index funds automatically reinvesting dividends are powerful. What about crashes? Now let's address the fear. The market crashes. 2000, 2001, 2002. During the financial crisis of 2008, the market fell over 50%. That sounds terrifying, but here's what history shows. Every major crash in U.S. stock market history has eventually recovered. Investors who sold during panic locked in losses. Investors who stayed invested benefited from recovery. Time in the market has historically beaten timing the market. 30 years smooths volatility. Why 30 years is the sweet spot? Compounding needs time. In 5 years, returns look random. In 10 years, still volatile. In 20 years, patterns form. In 30 years, probability becomes powerful. Over most 30-year rolling periods in modern history, the S&P 500 has delivered positive returns. The longer the horizon, the higher the odds. This is why retirement accounts are built around long-term index investing. The SP 500 doesn't make people rich overnight. It builds wealth slowly, quietly, relentlessly. It works because the U.S. economy grows, companies innovate, profits compound, dividends reinvest, weak companies get replaced. Time does the heavy lifting. The real secret isn't intelligence, it's patience. And in a world obsessed with fast money, patience becomes a competitive advantage.